Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. U.S. Treasury yields have been on the rise through this week, kind of flat on the day here. Members of the House in the U.S. have approved a new bill with a staggering $4 trillion price tag, pushing yields to levels not really seen since 2023. So with the yield story suggesting caution while equity markets remain pretty buoyant, our next guest says this disconnect could challenge the traditional 60-40 portfolio. And could this ultimately be a tailwind for a long-short strategy? Joining us here to unpack some of the pieces of those questions, the answers to those, and the benefits of liquid alternatives in a portfolio, and to provide you with an update on Fidelity Long Short Alternative Fund, is portfolio manager David Way. Great to see you. How are you?
Nice to see you. I'm well. How about yourself?
Very well, thanks.
Great.
Yeah, great to have you join us here. This is a very interesting moment because lots of people are talking about the 60-40 maybe being adjusted, maybe not being the moment. Why don't we actually just begin there for a second? What do you think of that?
Sure. I think the opportunity as a long-short manager is to provide something that's quite additive to a 60-40 portfolio. The challenge we have today is that equity markets, are doing well against a backdrop of bond yields rising. And when we've seen periods of corrections, we've actually seen bonds and stocks have positive correlation. So
they go down together,
exactly,
or up together.
So as people think about future-proofing their portfolios and thinking about downside protection, having a long-short strategy, something that does a lot better job than a long-only fund or the broader indices at protecting downside, is something that could provide really nice additional downside protection and a diversifying effect to the traditional 60-40.
I do want to ask a bit about the moment with tariffs. You obviously, and everyone at Fidelity is very involved with speaking to the company heads, making sure you have an understanding of where exposures are, sort of first derivative, second derivative, and all the way down. What do you think? The markets seem to think that this is a snapback moment. Maybe the worst concerns are over. There's been a bit of a peak uncertainty discussion, peak tariff discussion. Maybe that's over. How do you think that through?
I think where I start from is where I was positioned or thinking in the early part of this year. And I think I've been in the studio a couple of times talking about my expectation that we would see tariffs that would be A, broadly based, and B, higher on certain countries, including China. And when we saw the tariff announcement on April 2nd, what we saw was an even sort of worse case than that initial base expectation. And so a funny thing happened in early April where the tariffs that were announced were so bad and drove the market down so significantly, the thinking sort of switched to, well, they can't implement this because the market is telling policymakers that this will break the economy. And so the ultimate landing spot for tariffs remains uncertain. I think I'm still sticking with that case where we will see broad-based tariffs. And they will be higher on some countries than others, obviously more benign than what we saw announced on April 2nd. And what that means is that when we got into the depths of the market drawdown, you could actually look at companies that were pricing in these much higher, unlikely to be implemented tariffs. And as a long-short manager, I did one of two things. I either looked at potentially buying some of these stocks that were really meaningfully negatively affected, as well as covering shorts where I had expected tariffs and expected a negative share price reaction. So it was one of those cases where the bad news becomes good news.
That's really interesting, but you were very much at work because there are some investors who will say, the beginning of the year we did expect many of those things, and in fact, that is what happened, and so there wasn't actually a lot of reason to move too quickly. Not the case for you.
I think for my fund in particular, my view of how tariffs would play out were at least in the right direction as what was announced. And so a lot of my positioning in February and March was around building that sort of resiliency to this type of event. And secondarily, just given the dramatic price action we saw in some of the companies that were more tariff affected, those would be the stocks that would be in my short portfolio. It was really an opportunity to think about taking profits and understanding that perhaps the risk and reward trade-off did not favor staying short. So for me, I just tend to follow the process and look at risk reward, upside, downside, and when things get skewed in your favor, invest heavily. And when things start to look less favorable, like even if they're going in the right direction currently, you move on and find other ideas.
So tell us how this ultimately can work in the market. The exposures that you would have to this market are obviously the long side of the portfolio allows you to have the upside exposure to markets, and we've seen that significantly over the last couple of weeks. Where else would you point out the exposure?
There's really three sources of return. So the first you mentioned, the long portfolio. This is about taking advantage of our research and my own sort of worldview and individual stock work, and just trying to find great companies that I think will be better stocks over a 2 to 3 year period than the market. And that, as you said, that will have some positive correlation. That part of the portfolio generally benefits from rising equity markets, which is the very long-term history of life. Like the markets tend to go up, even though it can feel like a roller coaster at times. The second piece of the portfolio, the short portfolio, there's an opportunity to earn returns from stocks going down. And those tend to generate profits for the fund in periods of volatility or the market's going down. So the returns from that part of the fund have a negative correlation. And then the third piece kind of sits in the middle, where to the extent I'm able to identify long securities that outperform short securities, like even if the short stocks go up a little bit, if the longs go up more, you can actually capture a spread between those two portfolios, and that's uncorrelated. So part of the what I think the magic or opportunity in this fund is you basically have three buckets of return, only one of which has a positive correlation to the market. You have another one that has a negative correlation to the market, and you have one that should be less correlated.
Truly alternative in that sense. And if people are worried about where the markets are going and trying to diversify, this is sort of the classic way of looking at that. The spread that you mentioned there is the spread that often people would invest in a 60-40 for those very reasons, right? You would make sure that you had protection to the downside in a bond portfolio in the realm of 40%, and equity or something more risky on the 60%. Tell us a little bit the rate story that's in there, because that is also playing into the bond markets right now. We started off with yields having a real rise this week.
Mm-hmm. Yeah, I think there's a few really interesting and important themes in the market that will sort of drive the direction of where we go from here. And one of them is what seems to be emerging is a bit of a disconnect or a difference of opinion between the bond market and the equity market. And we've seen this come up in the past few years as the bond markets started to price in perhaps more recession odds than the equity markets did. But really there's a disagreement about what the cost of capital in the marketplace is today. And
do we ask why, or you just take that and invest
I think,
but why is that?
I think the bond market's looking at the relative risk of investing in bonds, where you effectively, hopefully if you buy a bond for 100, you earn the coupon and get paid back. Right. Tends to reflect a more risk-averse part of the investing portfolio. And so to the extent people perceive risk, whether it's the budget bill that's making incremental progress, which
with a lot of coffee.
Yeah, absolutely. People are trying to make this bill happen very quickly. And I think the key implication, if that bill is successful, is that hopes of reducing the US deficit from levels that people broadly agree is unsustainable is unlikely to move forward. And we're likely to see more deficits, which means inflation and potential pressure on global investors' willingness to fund U.S. government deficits on a go-forward basis.
And the bond market is seeing that. I mean, that's the rate story there. That's ultimately what's being reacted to this week on the rate side of things. Equity side of but you can what I'm saying is you can play both sides of it just from the equity exposure, which is interesting.
Yeah, and so the equity markets seem to be looking past this to the positive side of this bill, which is that growth is likely to continue. There isn't going to be a demand shock caused by the government reducing its spending, and or significant pullbacks in the large infrastructure projects that we've talked about in the past as being a key driver of relatively strong industrial activity in the U.S. versus the rest of the world. So it's sort of like a glass half full, glass half empty debate. But as a long-short manager, I think it creates a really interesting divergence and an opportunity to position the long portfolio for the potential that the bond market's right, as well as identify shorts where these higher rates are having a meaningful impact on their interest rates they pay on their debt, their ability to refinance, Because if you can get a US government bond at close to 5% and you are a lower quality borrower, like perhaps a high yield borrower, it hasn't happened yet, but it's quite possible that spreads could widen. And as interest rate costs go up, there's more financial distress in the system. We're seeing a little bit of that at the consumer level. And I think it's quite clear that bond spreads are perhaps not pricing in the level of distress and default risk that we might see in the next couple of years.
What does that make you do with your short side of the portfolio then?
For me, one of my core bread and butter shorts are companies that are not growing and have too much debt, because you really have to operate from a position of weakness where every quarter you're working to keep things alive. And the reality is, as we saw in April, a lot of these stocks really suffered. And operationally, their ability to navigate through tariffs is weakened by their financial position. So this is really an environment where perhaps the strong may get stronger, the weak get weaker. And if bond yields remain elevated, the odds of financial distress in this sort of cohort of stocks increases, which makes them attractive short candidates.
That's interesting. Give us the universe that you invest in. Remind us. You're across North America. You can also go international. You have a trip coming up, actually.
I do. So my primary benchmark is North America, so Canada and the US. And it's a sort of prospectus requirement that 90% of the fund is invested in those geographies. And then with the residual 10%, I have the ability to have some flexibility. And there has been some interesting developments in Europe over the last couple of years. It's been really like a growth desert for 15 years.
Last couple of years, you've seen opportunities, because it seems like it's just a this year story. But maybe that's...
Yeah, so I think the Ukraine war in 2022 really caused the beginning of a major rethink about how the European economy is ordered. I would say the 15 years before that, in very broad strokes, would be a path towards deindustrialization, trying to meet green objectives by closing plants and closing electrical generation in Europe and moving those plants abroad, principally to Asia and China.
And all on cheap gas.
And all on cheap gas. And I think the reality of the Ukraine war highlighted the relative insecurity of that policy. And so last year, my exposure to Europe, largely consisted of exposure to the defense industry. Right. I think people thought that the end of the war in the Ukraine would actually bring a decline in defense spending. And it was my position that the war in Ukraine will likely ultimately end by the removal of the security guarantee that has largely protected Europe, the US, since the end of World War II. And that would require basically Europe to go it alone and spend more on defense. And so I think that was sort of the first leg of opportunity. And more as we look forward, it's really about the potential for fiscal stimulus. Like Germany has a very low debt to GDP. They actually have the ability to stimulate the economy if they want to. And I think the security angle is really the thing that is pushing them to take the steps to do that. And so I am going to Europe, and I'm meeting with about 25 companies across industries looking for opportunities. So I've done some work. I have some hunches about where the opportunities might rest. But for me, it is an important part of the process to go meet companies, test my hypotheses, and hopefully I get 2 or 3 ideas out of there that can supplement that sort of the rest of the core portfolio, which I remain excited about. If Europe's an opportunity, there's a lot of US companies that have European businesses. And so part of some of the areas where I'm interested in Europe, the stocks to buy are actually still in the US. So I know there's a lot of hand-wringing about, is capital going to flee the US markets and go back to Europe? Or does the US still have a path forward? Yeah, it could just be an additional growth driver on a stock that we already think is attractive. So for me, it's really about balancing that. If I do go into that 10% sort of outside the benchmark, I want to be really confident that it's a good idea, and I want it to provide a unique exposure or access to an opportunity that I can't source in North America.
Do the ideas, you can't tell me too much, but do they have to do, or are they contingent on, or would they benefit from peace in Europe?
So I think obviously the catalyst. Hopefully we're getting towards the end of the conflict and a resolution. And really from there, it's really about rebuilding defense in Europe and the ability to defend Europe against Russia, which is their primary antagonist. And that will lead to a lot of things. As I talked about the deindustrialization, there's a lot of parts of the supply chain and industrial base that will need to be invested in. And that could have diffuse impacts into the financial sector, which is going to have to provide loans to enable that investment.
And that would be necessarily European financials or even US?
It could be the US. I mean, there have been some signals that the European banks are gaining market share in Europe-based deals. And so the European banks could be interesting. They earn much lower returns than US and Canadian banks, but the valuations are also much lower. So again, because I'm style agnostic, like there are some very interesting things on the value side that could be quite interesting. But it might be something else. It could be something in the consumer or industrial sector where just a higher level of economic activity. Like we've seen how stimulative government deficits have been in the US and Canada, and Europe is lagging in that area. And so while they face demographic challenges, I also think at the same time there is the potential for the fiscal impulse to get more diffused in the economy. So it could be a retailer. It could be an industrial company that does testing around new facilities. Like there could be very diffuse impacts. And I think that market has been stagnant for so long. Right. It'll be very interesting to see who has the capacity to take on that growth and then who can capture it.
Okay, fascinating. We'll obviously have to catch up with you on that. There's a question coming in. You've noted some of these points. Maybe just wrap it up for us. Are you finding, David, more long opportunities outside the US? Are you finding more shorting opportunities in the US market?
Yeah, I think in the US, the rapid snapback we've seen tells us...
Is that going to hold? What do you think?
Personally, my main concern is that the market is really discounting, a material impact from tariffs. And I think in the very short run, what we're seeing is potentially some pre-buying as people try to front run higher prices. We have Walmart's CEO saying that they are going to have to take price increases. And so when you see higher expectations for prices in the future, it tends to pull forward demand. So some of the numbers actually have been relatively strong in the quarter. And for me, what I'm worried about is if we do see tariffs, these tariffs will have impact on cost structures. It will lead to price increases, potential risk to demand.
For U.S. companies.
U.S. companies, but there's like always great companies. Like for me, it's really becomes one part of the thesis. And if you have a company that is doing something else, maybe they've sold a division that was a huge problem, and now they have a clean slate and a clean balance sheet. Even if they're tariff affected, they can be great stocks.
Right. Okay.
And so it becomes. But I would say that from a name count perspective, I am buying more stocks in the U.S. than I am buying in Europe. And on the short side, like this rapid snapback and sort of kind of buy the dip approach. A lot of the shorts I covered in April, could be very attractive again because they've all bounced back.
Okay.
And so I think from a short perspective, I'm definitely finding a lot of ideas, which I need because when we got into early mid-April, a lot of the stocks got bombed out, and I don't necessarily wait to replace them with a different short. So, if you're covering shorts, you need to constantly be refilling the pipeline. And so for me, I just kind of go through the 200 stocks or so that I know really well and have a thesis around when I'd short them. And if the price gets to a level where I get comfortable about the risk reward, it's time to put them back in the fund.
Right, and they're names that you know and that you've already been looking into. Back to sort of the international front a little bit, the discussion of where tariffs stick at higher rates. I think they're probably, well, who knows? It looks like they're going to stick everywhere a little bit, but at higher rates. So the idea of sort of figuring out where the origin of products are and how that works for even for Canada, for Mexico, for others. Again, just sort of go into the companies themselves and how that's going to work. Because there's some companies that obviously put things together with parts from all over the world.
Yeah, I think it's a huge challenge. And I think when the tariffs were announced rapidly, a lot of companies didn't have the internal processes to keep track of that. So I think within the USMCA, there was a better ability to do that. It was really about uncertainty about whether
There is a framework there.
Whether the USMCA pieces were compliant or would they be subject to tariffs, particularly the auto parts crossing the border dozens of times. And we actually may get some directional update on that. There's obviously the G7 coming out, the prospect of a sideline discussion with between Bassan and Carney that would give us some clarity around what things look like for Canada. I do think that one of the pieces of global trade that will change is the idea of companies exporting from a high tariff country to a lower tariff country, but still not the U.S., changing the boxes and
so we're talking about China to Vietnam.
Yeah, exactly. That would be one example. And I think that's one of the pieces where the U.S. government wants to see material change. And I think it's where, perhaps it's really fair to ask that.
Because were the tariffs on Vietnam like 300%? Or I mean, they weren't.
Yeah, I want to say
outrageous.
maybe in the 50s, which was a big surprise.
But the message there was, don't rebox it. Yeah.
Correct.
Right. Okay. Really interesting how some of that's going to kind of come back around. Does the currency story interest you right now? It fits a little bit in the box with rates and maybe the question of stagflation and others and debt. Does it affect how you invest if you see a dollar going down or a different currency going down or up?
Certainly there is the last many years, it's been really a one-way move. We've had some volatility, but if you look at the Canadian dollar versus the US dollar, I would have been in the camp, especially in sort of the 125, 130 range, that pressure would be, against the Canadian dollar. And now we're sort of in a bit of a holding period around sort of the 140 level, where there's the concern about what's happening in the US. There's concern about what's happening in Canada, our level of indebtedness, economic activity, impact of tariffs on economic activity and growth. And so I think there's perhaps a better balancing point between Canada and the US dollar. I don't speculate so much or make active bets on the currency, but I do think that is an area to watch. And in particular, I think the euro US dollar, we've seen a bigger move and perhaps more durable. And so it really means a couple of things. If you're a US company selling in Europe, your euro sales get translated at a higher level, which is positive. But if you're a Swiss company selling in the US and even into Europe, where I believe the franc's appreciated, your sales are going down. So hopefully your costs are matched to that, but it does create some translation issues. And our analysts have 30 lines of code in their models that help us understand how things are changing.
Kind of fascinating. So what does Canada look like right now for investors as a place to be? Is there enough clarity? We'll say that the elections happened. I don't know if you think that there is policy clarity. I don't think anyone thinks there's policy clarity at this point, but are you lined up for anything there, or do you need a lot more to land?
Yeah, I think the policy direction appears to be not materially changed. I think from the previous government, you have a new leader. You perhaps have a slightly different structure in cabinet, but it's kind of the same people. Okay. And I guess I'm watching for signals that, in areas of, say, like fiscal restraint, maybe our deficits too high, or perhaps there's investment that we will need to make to improve productivity in Canada to offset the tariff effects.
But you can't see it yet. I mean, my point is
I don't think we have a lot of policy clarity. I think the government seems very clearly focused on blunting the near-term impact of tariffs with a fiscal response, which may or may not be the right approach, and at the same time negotiating some clarity or a deal with the U.S. So we at least know our starting point on where we stand. But rates are lower in Canada, and I think that's a big positive, because 2 years ago we were really worried about refinancing of single-family homes. Housing market remains under pressure, but at least from a cash flow perspective, the starting point on a 5-year mortgage, as we hit a big renewal wall from 2020 and 2021,
we're basically in it.
25 and 26, we're in it now, and TD reported positive results this morning, and so I think there are signals and macro indicators to suggest that pressure is in a lot better place than it was 12 months ago. And so, Canada is a great country for many companies, and, the fund obviously invests there. And for me, what I'm really focused on is, kind of the best ideas that I can find in Canada. I tend not to have a lot of sector diversification. It's really about finding the best ideas that complement, the rest of the portfolio, which is based in the US, and trying to access, better growth. Historically, that's been international growth and expansion. Some of our best companies are global champions in what they do. But within the consumer discretionary sector, like Dollarama owned it as of the last disclosure, and to the extent there is economic weakness, they will benefit from trade down. The unit economics of the store are amazing, and so
does it matter a lot of little plastic things come from China?
Well, in the short run, it could be positive. If the tariffs are very high on the U.S., the Chinese production will need to find a home for the things that they're making. And
we've already got some of that third country.
Yeah, and so there could be a potential benefit. And if Walmart needs to raise prices to offset tariffs, they might take some price in Canada to help offset the tariff effect in the U.S. And as Walmart raises prices, it lets Dollarama either get more volume or raise prices as well.
I mean, companies are being told by the U.S. administration to eat it, essentially, and to take care of it themselves to an extent, rather than advertise that this is a higher price because of. So that's interesting where else they might find it, as you say.
And that's what Home Depot said the other day, is that we're not raising prices. Yeah. But that's what they said.
That's what they said. Okay. Is stagflation, back to kind of the rates macro story, either your base case or close to it?
Yeah, I mean, I think about stagflation as being a combination of slow growth and higher inflation. And I think that with, if the budget bill in the US progresses and we're looking at 7% of GDP deficits, I think that will be inflationary. And I think at the same time, it's really continuing a level of spend. And so it may not be significantly additive to growth. So if you have higher inflation and no change in growth, it does create a bit of a challenge. And so
is this the fund for that?
So what I was going to say was
because you can invest everything.
On the long side, like there's going to be companies that can pass the price on, where they have pricing power, there's something special about their product or how they distribute it, where the continuation of like a reasonable level of growth, even if prices are higher, they can pass it on and they should be fine. And then on the short side, there are companies that could be in a really tough spot. And so that's where, in the short portfolio, I can look at the industries that don't have pricing power. Maybe they have too much debt, and maybe they're going to have problems on the revenue side as well. And, that's really the ideal scenario on the short side, where a company, kind of hits a dead end.
Sounds like this is the fund for it.
I hope so.
Okay, David Way, it's great to catch up with you, and thank you for sharing your thoughts and how you're investing, and ultimately this moment in time for your particular fund. All the best. Safe travels to Europe.
Yeah, thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.